Chic. Hello everyone, and welcome back to the channel. Today, we're diving into a crucial topic that's set to affect millions of people across the UK, particularly pensioners. There's a major financial shift on the horizon, and it's essential to understand what's happening and how it could impact you or your loved ones. So, grab a cuppa, and let's get into it. The Institute for Fiscal Studies, or IFS, has just released some eye-opening analysis. They're warning that by the financial year 2027 to 28, every single person receiving the full new state pension will be paying income tax. Let that sink in. Currently, less than half of state pensioners pay tax on their pension income. But within just a few years, that figure is projected to jump to 100%. So, what's driving this massive change? It all comes down to a government policy decision: the freezing of tax thresholds. While the value of the state pension continues to rise thanks to things like the triple locked amount you can earn before you start paying income tax, known as the personal allowance, this isn't just a minor tweak to the tax system. The IFS calls it a fundamental change in how the state pension is treated. Think about it, a system where a state benefit, designed to provide a basic standard of living in retirement, automatically pushes its recipients into the income tax bracket. It's a huge shift from what we've been used to. Now, you might remember that last year, Chancellor Rachel Reeves said she wouldn't extend this freeze on tax thresholds. The reasoning was that it would hurt working people. However, given the current state of public finances, the expectation is that this position might be reversed in the upcoming budget. It's a classic case of what's known as a stealth tax. What is a stealth tax? It's when the government brings in more tax revenue without actually increasing the headline tax rates like 20% or 40%. By freezing the thresholds, as wages and pensions rise with inflation, more and more people are pushed over the tax-free personal allowance or into higher tax brackets. You end up paying more tax, but the government can say they haven't raised income tax rates. The IFS ran the numbers on this. Vic Chancellor decides to extend the freeze for another 2 years. Until April 2030, it would raise an extra £8.3 billion in that single year alone. The think tank has highlighted that this freeze, which was originally brought in by the previous Conservative government in April 2023, has already had a major effect on who pays income tax and how much they're paying. Older Britons are, quite understandably, already concerned about this rising tax burden. We're seeing more and more reports and discussions about how this stealth tax is hitting pensioners particularly hard. It's a quiet but powerful change that slowly erodes the real value of their income. But the consequences go even further than just collecting more tax. The IFS warns of some unexpected and complicated knock-on effects. Here's a really interesting one. Single pensioners who rely solely on the state pension could find themselves in a bizarre situation. Thoughts? Once income tax is deducted from their pension, their net income might fall below the threshold for means-tested benefits, like pension credits. So, they pay income tax to the government with one hand, only to become eligible to claim benefits back with the other. This would create a huge administrative headache. Not just for the government departments that have to process all this, but also for older people. Many would suddenly need to navigate the complex and often confusing benefit system for the first time, just to claim back what they're entitled to. This could also open the door to other entitlements that come with pension credits, such as a free TV license. It creates a circular and inefficient system where money is essentially just being moved around between different government pots, with a lot of paperwork and stress for the individuals involved. And it's not just pensioners who are affected. This policy has a significant impact on lower-paid workers too. As their wages increase, perhaps through a hard-earned pay rise, the Treasury will claim a larger and larger share of that increase through tax. This can be really demotivating, as the real value of a pay rise is diminished before it even hits their bank account. The IFS has been quite critical of using these multi-year freezes as a policy tool. They argue that because inflation is so unpredictable, it's impossible to know for sure how much revenue these freezes will generate. It also makes the real value of the tax thresholds a moving target, creating uncertainty for households trying to plan their finances. Matthew Alton, a research economist at the IFS, put it plainly. He said, The freezes to personal tax thresholds have already represented a huge tax rise. Extending them would raise significant revenue in a broad-based and progressive way. That's the technical way of saying it affects everyone and brings in a lot of cash for the government. Of course, the government has its own perspective. A Treasury spokesperson defended their position by highlighting their commitment to the triple lock, which they say will give 12 million pensioners an increase of up to £470 a year. They also pointed to their efforts to boost the uptake of pension credit, which has resulted in over 57,000 extra households receiving the benefit, worth an average of £4,300 a year. But critics aren't convinced. The Liberal Democrat Deputy Leader, Daisy Cooper, condemned the policy, calling it yet another unfair measure that will penalize pensioners and hammer the low-pay. This sentiment is shared by many who see the freeze as an unfair burden on those who can least afford it, including retirees on fixed incomes. So, what does this all mean for the average person? It means that if you're approaching retirement or are already retired, you need to be aware that your state pension, which you might have assumed would be tax-free, is very likely to become taxable income. Debts. This will reduce your net income and is something you absolutely need to factor into your retirement budget. This situation highlights a growing tension in public policy. On one hand, we have the triple lock, which is designed to protect the value of the state pension. On the other hand, we have frozen tax thresholds, which claw back a portion of that increase through taxation. It feels like giving with one hand and taking away with the other. As we head towards the next budget, all eyes will be on the Chancellor to see what decision is made. Will the freeze be extended, solidifying this new reality for pensioners? Or will there be a change of course? Whatever happens, this issue has brought the complex relationship between pensions, taxes, and benefits into sharp focus. It's a stark reminder that financial planning in retirement is more important than ever. Understanding how these policies interact and affect your personal finances is key to navigating the years ahead. We'll be keeping a close eye on this story as it develops, and will bring you any updates as soon as we have them. Thanks so much for watching. This is a really important topic, so if you found this video helpful, please give it a thumbs up and consider subscribing for more financial news and analysis. And please, share your thoughts in the comments below. How do you feel about the state pension becoming taxable for everyone? We'd love to hear from you. Take care, and we'll see you in the next video.